Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures has finally moved outside of the sideways congestion that we have seen since the middle of March. Not too long ago, we made a projection that about June 6th is a potential good timeline for this market to finally complete its consolidation phase and finally break out. Confirmation of breaking outside of that sideways congestion would be the ability of breaking above the 380 mark that has held the market down for quite some time. We finally saw the market break through that 380 level, and from there the market was able to reach our minimum price objective of about 390, where we had a potential for the market reaching about 400 by mid-month. That mid-month time factor has now arrived, and the market met very good resistance just above 390. From here, the market has since declined a bit and has been in a sideways movement. But now that we have met our mid-month objective, we would simply be looking to sit on the sidelines until the next opportunity materializes. What had been key resistance at the 380 mark now has become key support for this market. And as you can see, the downdraft that we saw over the last couple of days fell right at about that 380 mark. But additionally, we can see how our 2x1 angle has situated itself as very good support as the market has come in here. It's going to be important for this market to be able to break previous highs if it's able to actually get a little bit higher. But for now, we anticipate that either this green downside angle will be good resistance, or over the next day or two, the market simply moves sideways and finds its way with another leg down. But from here, regardless, we're simply going to wait to allow the market to speak to us and give us a better indication as to what it might want to do. Part of the reasoning for the market halting near that 390 mark is that the market did reach volatility-based resistance overhead, and just a day prior, it did hit off on one of our end bands. Downside support, you can see, is consistent with our sinusoidal natural wave coming in for the market, and we're currently sitting just below the 315-degree mark at 384 3/4, which has given the market a bit of trouble over the last day or two. Downside, we still continue to have a key level at the 360-degree mark at 375. And so whether or not the market's able to either clearly stay above this 385 mark or break below the 375 mark will be very important. It's also key to note that over the next 2 weeks, the market will be having its first notice date. We'll be rolling over to the next contract of consequence. And so from here, we may see the market just simply move sideways going into that first notice date. As would be expected, the December contract's going to have a very similar price action. And as you can see, we've long been talking about how the sequential higher lows was a precursor to a potential big move to the upside. Once we got that fourth higher low that we had discussed, we can see a very nice big move to the upside for this December contract. Additionally, we applied our signature point high-low forecast factor. That gave us a timeline of June 10th for another potential turn for this contract. In doing so, since June 10th fell on the weekend, either the trading day before or the trading day afterward would be a potential high for this contract. And as we can see here, the trading day that landed right about that 10th or the day before gave us the high market close for that particular time factor. From here, the market did decline for a couple days and has since been moving sideways. We're now bumping up against the 1x1 angle for this contract here, where we find very good support. It bounces along this level here, but just overhead near 402, 403, we're also seeing very good resistance. The December contract, like the July contract, also met up against the end band and volatility-based resistance overhead. And as discussed in the past, whenever markets make a move to volatility-based support or resistance, we can often expect a 5 to 7 day sideways or change of trend movement. Upon hitting volatility-based resistance overhead here, we are now hitting right at about 5 trading days from actually having first initially reached that zone. And once we're past this 5 to 8 threshold, a trend can either resume back to the upside or the market can in fact reverse back down. As we can see in today's movement, half of the move from the day today has already been given up. And so if we see a seller's bar over the next day or two, we could very well be looking at continued weakness for this contract. July beans found great support up against our 1x1 angle down below. It tagged here for about 4 or 5 days or so, and from here the market moved up very nicely. Now, we had a turn point timeline of June 11th for this contract, and as you can see, as evidence here, the market came in right inside of that timeline and has since been moving sideways. The market's not quite overbought as of yet, so the potential for another leg up that tests the upside 1x1 angle is in fact possible. But from here, once the market is able to reach oversold, we would anticipate that the market would have a nice leg to the downside from there. The last time that the market did reach an overbought position, you can see the market did turn down very well. But the initial time that it did hit, the market simply became range bound and was sideways. That's part of why we like to see a very clean retracement first that hits up against very good resistance before projecting a potential downturn. Part of what we're also looking at here is the nature or the strength at which this market did decline. You can see it was a very strong move to the downside, and when we look at the same number of bars on the way up on the counter trend, you can see that the market's barely able to make it about 50% of the range of the previous downdraft in the same number of bars. That is what we call overbalance. And when we meet overbalance, that means that the market is predisposed to continued weakness until something else can in fact occur. The sideways movement that we're seeing here is one of two things. Either it's a distribution or it's potentially accumulation. The way in which it bounces out of this area or out of this zone is going to be very key. So if it breaks the top side with strength, then we can anticipate a move that is equal to this length that we saw on the other side, which again would point to the market coming up to find resistance up against that downside 1x1 angle. If it breaks from here, then it is particularly weak, and from here we can expect another move that's just as big as the leg that led it into this move previously. You'll also notice that the level that the market is touching now is the 942 natural quartile level. In the past, it was fantastic support when the market marginally touched it several months ago. The next time it tested it, you can see the market did bounce off of that level. When it finally broke through, you can see a very nice move to the downside. And from here, we're now testing it again. And once again, what was previously support has now become resistance. And so from here, what we do anticipate then is the way in which the market responds from this area, given that we're actually sitting up against a time factor. We're sitting at an important threshold from which the market can make a very nice move to either side. It comes at no surprise that the consolidation that we're seeing here coincides with being inside of volatility-based resistance. The market had tested the sinusoidal wave just below and finally broke through above the 180-degree mark of 922. Now that we're clearly above this level, we do have potential resistance sitting at 952.5. If the market makes a marginal break to this area and then breaks back down, that is also quite possible. And again, upon breaking down from here, we would look for a downside target, perhaps to reach volatility-based support down below at about 905.5. We can see much of the same here for the November contract. We made a significant low near that June 3rd timeline, and now we sit at about June 10th, where we can see the market came in and gave us a nice, reasonable potential topping formation. We have support just above this 938, 939 level. The market's bounced here a couple of times inside of this consolidation, and we have overhead resistance right at the 950 mark. Where the market sits right now, once again, it's not quite overbought as of yet, and so we'd like to see it reach overbought before anticipating a move to the downside. But like the previous July contract, we can see that we are in a position where overbalance is in play. For the balance of this week, we're looking at key support sitting at the 90-degree mark at 934 and key resistance overhead at the 135 mark at 949. As long as this market stays range bound inside of this zone for the balance of this, we can anticipate potentially much of the same the following week. If we close on either side above this 949 or below the 934 this week, we would anticipate continued motion in that direction. in the event of a close of either side of the market. Wheat futures has been on quite the wild ride the past few days. First, we have a timeline coming in near June 14th for a potential turn. Previous to that, the market had reached an overbought position, and from there, the market actually did decline in a pretty strong fashion down to our Fibonacci 61.8% area of 433 and a quarter. From there, the market did bounce and found good support. In addition to that, that support level happened to coincide with our downside 2x1 angle. From here, we can see how the market actually did very well against this angle in terms of finding resistance consistently. It finally broke above where the market was able to actually have a nice advance to the upside, falling just shy of the 2x1 angle above. From here, the market declined back down and found support at that same angle again, which again was in conjunction with that 433 and a quarter number. From here, the market has since bounced back up again, and whether or not it's able to eclipse the previous high is going to be key. But from here, we can see some strength given the narrative that we have been seeing in the news with regard to spring wheat. So from here, the potential of this market actually reaching higher is still plausible. And we can see here that the market is returning back up above to being in an overbought position again. The second go around, if it does reach an overbought position in conjunction with breaching the previous highs, then an uptrend may in fact find some traction where this market can continue to move a little bit higher. The June 14th date is going to be important for this contract overall, and the way in which this market responds over the next day or two will be very important. Volatility-based resistance was probably key in causing the reversal that we did see a few days ago. And from here, as would be expected, we look for about 5 to 7 days of sideways movement or the potential for a change in trend. Upon reaching volatility-based resistance, the market did decline for a couple days, and now we see that it's been up for a couple days. Its ability to surpass the previous high is going to be very important here as the market is making its way back up through volatility-based resistance again. That key level that we'd been talking about previously of 441 was in fact the key level for this contract. Upon breaking that area here, we saw a swift move straight up to volatility-based resistance at 455 and 3/4. Upon reaching there, the market did give us a bit of a correction and is now testing that 451 and a quarter number. And so from here, over the next couple of days, we'll simply wait to see what materializes. One of the things that is potentially working to the benefit of the contract is that we're seeing a series of sequential higher lows. And so a breakout above, especially above the 462 number, could really point to continued strength for this contract. Given that first notice date for the July contract materializes in about 2 weeks, we took our analysis over to the December contract as well and wanted to determine whether or not an Elliott wave formation was in development for the December contract. From here, we can see where a significant low was made back in April, and from here the market made its initial advance, followed by a subsequent higher low. This initial move is what we will call the first leg of this move to the upside here, with the potential for continuation further up. Since we do not know where the market is going, we label this guy as a wave 1 or an A. If it's a wave 1, that indicates for us that the market is turning into a new trend to the upside versus an ABC correction where this would simply be a corrective move inside of the bigger or the larger downside rotation. From there, the market gave us a pullback, and we can see that we've labeled this here as wave 2 or wave B. From here, then, the key component is to whether or not we are in a new leg to the upside for a new trend or simply inside of a corrective movement. Part of the way in which we determine that is the distance at which this market is able to run on the other side. We look at a couple key components to give us a number if the probability exists for this market to reach even higher levels. So inside of here, then, part of what we do is we study the internals of the existing leg. So for now, we're living inside of what can be considered wave 3 or C, which would be this leg to the upside here in its movement. Now, from here, part of what we're going to do is we're going to look at a fractal or sub-movement inside of this leg. Here we have the smaller wave 1 or A, the smaller wave 2 or B, and a smaller wave 3 or C. Given that this market was able to break above the 484 and 3/4 number, the potential for it to touch 491.5 was highly probable. So from here, even though we saw a very deep correction come in to test the 470 number, the market has since started to make its way back up a bit. Additionally, the market didn't close below this 470 number, but in the event that it did close below 470, then what we would be looking at is an internal ABC, suggesting that the C leg from the bigger movement would terminate somewhere in this neighborhood here, and the market would simply decline and turn back down again. If it's able to get above the 491.5 number and close above there, then the potential of touching 499 to 500 is actually probable. And from there, we're looking at an ABC correction for the bigger move, and closing above 500 suggests that we may in fact be inside of a bigger move for the bigger Elliott wave sequence in this leg. Now, all of that can sound very confusing, but part of what we're looking at then are some of the key levels that we want to pay attention to. Essentially, what we're looking at then is the ability of the market to stay above 470 and its ability to close above 491.5 are the two very most important levels for this contract at this time. From this vantage point now, we can see where the market did become overbought in conjunction with hitting up against volatility-based resistance. In doing so, the market gave us a bit of a correction. We're about 4 or 5 days inside of that correction now, and overhead we have 496.5 as a potential key resistance level that lives at the 180-degree mark. So from here, if the market's able to basically close above that 496.5 number, we think continued strength is plausible. In addition to that, we can see how the volatility-based resistance bands are actually starting to turn up a bit, suggesting that there may be some legs for this market to the upside. In the event that it does fail from here and that it breaks down below that 470 number that we talked about before, and possibly even for now getting below the 474.5 this week, that would probably be a precursor of potential weakness, especially since we've seen a number of tops hit against that 475.5 number previously. If that level does not become support going forward, then the market will probably in fact turn back down. The move in the December cotton contract is finally playing out. We suggested a potential short entry level at 72.27 for this contract, and the market came in, touched that 72.27 number, and has since been breaking down. We had a minimum price objective to come in at about 71.63 with the potential of reaching 71.35. Today we've reached that 71.35 number, and we had a stop just above the previous market high near the point of control number of 73.22. So from here we can see the market is actually moving very nicely in concert with what our expectations were, since it was having a tough time in its ability to turn to the upside to reach the upside potential targets. From here, given the strength of the downside move that we're seeing, the potential for it to reach down to about 70.67 is plausible. And as we can see now, over the time, the market had been oversold, but since it's been oversold for a continued amount of time, it is now moving from being in a sideways position to now turning into a downside trend. The US dollar continues to find weakness, and we've labeled here a similar Elliott wave formation off of this contract for your reference. Here we can see after the market made a significant high on December 20th and came down to this B leg that we see here for a low on February 2nd, we took measurements off of this leg to give us forecasts as to where potential support and resistance in the future might lie. Taking that measurement then off of that range, we can see where the C leg then begins. And if we measure 1.272% of that movement, that lands us at 96.64. This was in fact very good resistance for quite some time. The market today is actually trading below that level, and if we close below this number once or twice this week, we anticipate that the dollar will reach the 95.11 mark at a minimum over the next couple of weeks. So from here we can see that weakness continues to be the narrative for the US dollar, and that could very well bode as potential strength for the commodity markets. From here, we would anticipate that the dollar would continue to find weakness until our next key time factor, which lies on July 17th, where it could then find support potentially near that 95.11 number that we're looking at right now. Previously, we had volatility-based support sitting near that 127.2 level, But now we've seen a shift in that actual range itself, and we have volatility-based support now making its way down, suggesting that downside pressure will continue for the dollar, suggesting that continued weakness is in fact probable for this contract in the coming weeks. In closing, we'll take a look at the September crude oil contract. We can see the small consolidation that occurred after the market had its nice move to the downside. Today, we see a very big leg to the downside in conjunction with our anticipated minimum price objective of 44.76 down to about 44.12. Today, we could very well reach that 44.76 number, which was the previous swing low. And so what we're looking at is the continued downdraft for this crude oil market that we anticipated for this move here. Upon reaching being overbought, we saw a very nice sell opportunity that we had been discussing over the last several weeks. And now the market has finally made its way down to that target we had discussed. And so we'd simply be looking for potential support to sit somewhere in the range of 42.27 to 42.38, which lands right inside of volatility-based support. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.